Hey, everybody. Thanks for tuning into this episode of the Real Estate CPA podcast. Your host, Brandon Hall and Thomas Caselli, coming to you live from Denver. We're out here on a partnership retreat. And what we're going to be discussing on today's episode of the podcast is the potential, or the proposed rather, Biden tax changes. Maybe a little bit late to the party, but we wanted to release an episode because we did receive a lot of questions on those potential changes and what that might mean for real estate investors. So without further ado, we're going to dive right in. And
I think it's important to point out that these changes are currently being negotiated in Congress. We don't actually have any formal bill yet, but we are expecting a formal bill in June or July. So we'll have a lot more information at that point as to what actually makes it through negotiations, which of these proposals makes it through, and whether or not they made it through unscathed or if they were changed at all.
Absolutely. But one thing to know what the proposed changes do tell you is the direction that they want to take it, and what the potential stuff that you might be impacted on. So first big change for investors of all types, really it comes down to the increased capital gains tax rate. That for people who have AGIs, so adjusted gross incomes in excess of $1 million, your capital gains rate would jump to 39.6% on the high end. So what that means for investors today is that you're basically going to be paying another 19.6% in capital gains tax on a long-term capital gains tax if you're earning over $1 million. And for investors who have very large capital gains from appreciated properties, that's going to potentially impact you.
Yeah, so it's only on gain in excess of $1 million, right?
It's once your AGI is, if your AGI is over $1 million, then you're in that 39.6% bracket.
Right. Okay. So the total, so once your total income then hits $1 million, that's when this max tax rate jumps up. So it's 39.6%. But you also have the net investment income tax. It's an additional 3.8% surtax that you would be paying at that point too. So you're really looking at, what is that, 43%, 42?
Yeah, I mean that's a lot. I mean that's a lot.
Yeah, that's you'd be looking at like 43 and a half. And then you have state as well, right? So all of our Californians, you've got, this is an extra 11 or 13%. In New York City, you've got an extra
3.8% in New York City. So it could easily creep up to like 45. Like I'm sure for some people even 50% or more. Yeah,
55, 60% even if this gets passed. And again, it's only on, I'll just say, income in excess of $1 million, capital gain income if your total income is in excess of $1 million. So if you're below the $1 million AGI, then you're okay. But if you're above that and then you liquidate, stock or real estate or anything like that, then you're gonna be faced with this really high tax rate. And so what's the obvious answer then? How do you avoid this? Well, you just hold the assets forever, right? Until you die, because when you die, you get that stepped up basis and it eliminates the gain. However, the Biden administration has a provision to basically hit any gain, I think, in excess of $1 million, you don't get a stepped up basis. So they know that you will just hold the asset until you die. And the way to then curb that is to say, well, on the $1 million, on the gain in excess of $1 million, you're actually not going to get a stepped up basis at all. So you're going to have to pay, your heirs will inherit your original basis, and then there will be some sort of estate tax levied there. So you can't just hold it anymore. We're assuming that if they pass one of these, they'll pass both of these too, because otherwise you would just hold the asset forever until you died.
Yeah.
And then the 39.6% increased rate would not really play a large role. And actually, there was a study done. I don't remember who did the study. It was recent. It was really recent. There was a study done that looked at what happens if you just use the increased gain, that 39.6%, and you don't do the stepped up basis, and it actually created a deficit. It's like it was a very low amount of revenue, but once you eliminate that stepped up basis, the tax revenue is humongous, or jumps up into the billions and hundreds of billions of dollars. So if one of these happens, the other one will happen as well. And you'll have to get a little more creative on your exit planning.
Yeah. I think what we're going to see if these two things are passed in conjunction is a renewed importance on estate planning. That's kind of, over the last few years with the Tax Cuts and Jobs Act, with the exemption being so high, 11.8, it's indexed for inflation, but for 2021, I'm pretty sure it's 11.58 million per person. So if you're a couple, you're looking at, around 23 million or so, give or take. And that's a significant amount. So for most people, the average couple is not going to have to worry about estate planning so much. But one of the other changes that they want to bring about is potentially decreasing that exemption from 11.8 million down to 3.5 million. That's the number that's proposed. And then increasing the estate tax rate from 40% to 45%. So when you kind of combine all these things together here, my guess is that if this stuff is passed, you're going to see a lot more people looking to how can they remove assets from their estate and move them into, like, say, irrevocable trusts, get them out of the estate, let them appreciate in the irrevocable trust so that they can somewhat curb the hit on that $3.5 million estate tax exemption, which is pretty low comparatively speaking. So
my understanding is that the Biden administration in their proposals has addressed trusts, usage of trusts in connection with the elimination of the stepped up basis, because they basically don't want you hiding assets in trusts if they're going to go and raise the top tax rate to 39.6% for long-term capital gains. So just be aware of that. I don't know to the extent, I didn't dive into it to really truly understand what they were trying to do. And everything that I just said, I could be misspeaking right now. But as these proposals come out, as these bills come out, get with your tax advisor and just make sure that you understand the full scope. Because I think that as it pertains to property with built-in appreciation, built-in gain, it might get a little harder to shelter that eventual tax burden under the Biden administration.
Yeah. You definitely want to speak to your advisor because you want to take a holistic approach here. Because if you're a high income earner, you're earning over $1 million, you have a lot of assets, you're a high net worth individual. There's going to be some things you're going to want to pay attention to. And one thing you also it depends on where you are in your life right now too, because, for example, if you're, 30, 40, 50 years old, this might not be a big deal because, look, if this gets proposed and this gets passed and someone comes into office, a new administration comes into office in 2024, 2028, or whenever, there's a chance that they change the rules and they might change them back. And now all of a sudden you're sitting here with a huge estate tax exemption again, and the estate, tax rate might be lowered potentially in the future. So it is a big, you have to sit down and talk to your advisor about where you're at, how this stuff's going to impact you specifically.
Yeah, and the process on this is going to be kind of interesting too. So Biden has promoted a bipartisan approach to tax reform. I don't know. I don't think it's as far as reform, but a bipartisan approach to these tax changes. But the reality is that it's not going to. There might be a bipartisan approach to some of the really small changes, but the Republicans are going to block. That's their intent, to block any changes that the Biden administration proposes. So the Biden administration then will look to the budget reconciliation process, and they have a slim majority in Congress, so they can get it done through the budget reconciliation process. Basically, what that means is they can force these changes through without any consent from the Republican side. However, they can't afford any, because of the slim majority that they have in Congress, they can't afford any defections from their own base. So, it'll be interesting to see how Biden kind of pulls all the Democrats together and what changes end up occurring. Like I know one that's a sticking point for California, New York City, or New York, and maybe New Jersey. Yeah. They've already, the congressmen and women have already band together and said, we're not signing any tax reform proposal, bill, anything, unless it includes a provision to remove the SALT cap limitations that were put in place in 2017. Those SALT cap limitations capped everybody that was taking itemized deductions at $10,000 for property taxes and income taxes.
Yeah.
And for people that live in California, New York, and New Jersey, if you're itemizing deductions, you're looking at your property tax bill, you're looking at your state income taxes, and you're opted in the $20, $30, $40, $50,000 range. But with the 2017 changes, you could only take the first 10,000. So what they're trying, what the some of the Democratic congressmen and women have done is they've band together and they've said, we're not going to sign anything that the Biden administration pushes out unless they include a provision to remove that $10,000 cap. So it's going to be interesting to see how it all plays out. I don't expect, based on what I understand about the process and political sentiment, I don't expect there to be a very much done with a bipartisan approach. But it'll still be interesting to see how much he's able to push through, even with his own base.
Yeah, these are, I was reading an article, and those people that are in Congress are I think the average age or something's like 58 or something like that, in the 50s, and they would be disincentivized to actually sign a bill like this, because these proposed changes, these are very aggressive, and obviously they're just proposed at this point, so they want to put forth their biggest asks so that when it gets chopped down, if it gets chopped down a little bit, or on the negotiating table, that they put themselves in the best position to get what they want. But I guess the point I'm trying to make is that in Congress, they might not actually be able to pass this because people in Congress would be negatively affected by this. So why would they why would they do that? Why would they vote against this? That's the theory. So we'll see.
Guess we'll see how it plays out. So let's talk about the 1031 exchange. That is another change that has been proposed, and that's a change that's going to affect a lot of real estate investors. The proposal is that you cannot defer gain in excess of $500,000. Do you know if that includes 1245 and 1250 recapture?
I don't know.
Is it total gain or just?
I've not looked into it that deeply yet. I don't know that they would address that. I don't know if they addressed that in the bill yet. But I mean, $500,000, people have highly appreciated properties, even if whether or not it includes it or not, it's still pretty, impressive.
Yeah, and that's one thing that I actually didn't look for either, because I've just kind of been reading the high level stuff at this point. I haven't actually dove into it.
Yeah.
So I don't know if it includes depreciation recapture. That's what the 1245 and 1250 recapture that I just mentioned is. It's depreciation recapture, and that creates additional gain, right? I can buy a property for $100,000, and if I depreciate it by $20,000, then my basis is $80,000. If I then sell it for $100,000, I have a $20,000 gain because my basis was $80,000 because I depreciated it, even though I sold the property for exactly the same amount that I bought it for. And that gain is called depreciation recapture. Normally you can 1031 depreciation recapture, so you can roll everything forward.
Yeah.
You can roll the depreciation recapture forward. You can roll the capital gain forward that comes from appreciation. I would be surprised if they were only targeting the capital. It's probably the entire thing. So anyway, it's capped at 500,000. So if you can still 1031 exchange property that has gain less than 500,000, but the proposal is that you cannot exchange property with gain in excess of 500, or you can, but a portion of that gain is going to be taxable immediately. And obviously that would hurt the real estate industry. That would hurt the 1031 exchange industry. The 1031 exchange industry has already started to band together to
try to block this.
Yeah. What's it called when you
lobby?
Yeah, lobby. Yeah. So the 1031 exchange industry has already lobbied. They're already banded together, start their lobbying. I mean, they're always doing it, but they've ramped it up. They've asked for help and I believe donations too from just real estate investors in general. And I saw an interesting study recently. It might have been by Ernst & Young, but it was a study that basically looked at the 1031 exchange industry, and they looked at how many jobs in the 1031 exchange industry would be wiped out if this rule was put in place. And then they kind of like backed into, those people will no longer have income, which, I don't think is totally true, because they would go find new jobs. But the idea was like, what's the actual net tax impact? And it was, I believe it was like negatively impactful after you factor in all the job loss that would occur in the 1031 exchange industry, because they would consolidate. They wouldn't need nearly as much.
There'd be less transactions taking place.
Yeah, less transactions, because it would fall outside of the scope of that 500K limitation. So, and I'm not sure if that's a 500. Is that 500K per property?
I think it's
per property.
I think it's a per property. Okay. So it's, if you're going to do a 1031 exchange, you're going to have a 500K limit. And I think the way it goes is you just pay tax on the gain above the 500K. So you're deferring 500K.
Yeah.
I'm pretty sure that's how I've been interpreting what I've been reading.
Yeah, it'll be interesting to see if anything actually happens with this, because I know that 1031s come up, in every administration. Should we change the 1031 code? And the reason for that is you've got just leagues of attorneys that are scouring the tax code and really just trying to find ways to raise tax revenue. And so eliminating the 1031 or proposing that is a good way to immediately raise a lot of tax revenue. But it's held up over time, so I don't know that anything will actually change. But that said, I mean, it has been kind of under attack. I mean, the last administration changed how 1031s worked. They, very clearly said that it's only real property, and then they said that you can exchange up to 15% of your
tangible personal property.
Incidental personal property. So they've been kind of attacking it and making changes. So it might change.
Yeah, but you got to look at the effects of what this. If you take a look at this bill, right? If you just look at if the passed the way it did, what's going to happen to the real estate
plan, right? No bill.
Oh, the plan, yeah. If this stuff did come to fruition, you got to look at it. Okay, if you don't have the 1031 exchange, you're extremely limited by it. You have an increased capital gains tax. Those two things would incentivize people to hold on to their properties longer, right? And that means less transactions in the marketplace. So that means less supply on the market because people don't want to sell. And assuming the demand stayed constant, you're going to have potentially even more higher prices potentially.
So you tell me that I should buy at today's extremely high prices?
I mean, look, you got to look at everything. This is just looking at the tax in isolation. You also got to look at what happens if interest rates get increased. If interest rates get increased, you might have a decrease in demand for real estate, which might counterbalance this, which may be all part of some master plan that we're about yet. I'm just speculating here completely.
So we're in, as Tom mentioned at the beginning of this podcast, myself and my three partners are here in Boulder, Colorado for the week. We're doing a partner offsite and be making some changes to the firm and improving it and systems and that type of thing. We're really excited about it. But one of the things that we were talking about was, we own real estate, and we were talking about how the valuations of the real estate that we own have increased. And we're all like, yeah, we could sell, but then what do you do? It's the classic, where do you park the cash after that? What do you do? Now you've got all this cash, but now what do you do? Because you can't go. You could sell your primary residence, and then what?
You have to go buy another one.
You got to go buy another in this hot market.
Yeah. So you're just you're not really cashing out, really.
Right. Just kind of up. I guess getting a refresh, but anyway, if these tax changes pass, like Tom said, it could further limit supply. And that's what's important to understand, is that it could just further limit supply, which would further increase the price disparity that we're seeing right now.
Yeah, and then when you do take a look at the elimination, when you look at the elimination of stepped up basis and the increase of state stuff, you might say that might counterbalance it. But I would say for only some people, because let's face it, if you're like 40 years old, and the elimination of stepped up basis comes in, you might be willing to take the risk to continue to hold the property for a long time, hoping that stepped up basis does come back into play, or it's not the most hottest thing on your mind right now. So really that might not counterbalance out as much as they think it will.
Mm-hmm.
Barring anything that would say that you can't use trust or limit the use of trust, I would just put all my stuff into trust. No, not everything. We'll see.
It depends on how trust law changes too, right?
Yeah. I mean, yeah. Okay. I mean, that's my take on this bill right now, is that it's gonna
proposal.
I keep saying the bill. It's a proposal. The proposal. And it's one thing. My conclusion is that it's going to raise taxes if this stuff gets passed. That's a definitive conclusion on people who hold real estate and other highly appreciated assets.
Yeah.
Thanks everybody for tuning into this episode of the Real Estate CPA podcast. We'll be back next week with another episode. But for right now, sit tight. And if you're scared of the Biden changes, feel free to contact your tax advisor to see how they might impact you in the future.